Today, I was honored to have Glenn Dubin on the podcast. Glenn is someone I consider a mentor and a friend, and I'm looking forward to sharing his insights and wisdom with you all. Glenn is the co-founder and former CEO of Highbridge Capital Management, one of the most prominent and influential hedge funds of the last century. Glenn founded Highbridge in 1992 with his partner, Henry Swieca. Highbridge was fully purchased by JPMorgan Asset Management in July 2009, with Glenn staying on before stepping down in 2013. He is now the principal of Dubin Co, his family office, and has found much success in his private investments. He's a founding board member of the Robin Hood Foundation, along Paul Tudor Jones, and a trustee of the Museum of Modern Art in New York. In his first podcast ever, Glenn and I discussed his career, advice, insights, trends and tailwinds, and philanthropy. We hope you enjoy this conversation, and thank you for tuning in.
Thank you for joining me, Glenn. I really appreciate this. This has been a long time in the making.
Amir, very nice to be with you.
So I want to start off in your early life. And I think a lot of people have the misconception that a lot of hedge fund managers are born with a silver spoon in their mouth. They get all their connections from birth, etc. But your father was a taxi driver. Tell me a little bit about your childhood in Washington Heights and kind of growing up and when you decided you wanted to get into Wall Street.
Sure. Well, as you mentioned, I grew up in Washington Heights, the northernmost part of Manhattan. My children like to say that Poppy grew up in the Bronx, so I don't, correct them. In the Bronx, northern Manhattan, it's really the same thing. My father drove a taxi, as you mentioned. I was the first one in my family to go to college. I went to the State University of New York at Stony Brook. I graduated in 1978 and immediately went into the real world to seek a profession where I could excel commercially and professionally.
And I want to there's this story you tell. You had 30 interviews. You set up 30 interviews with funds when you were coming out of college. And with firms. In the first 29, you didn't get the job. In the 30th, tell us about the 30th with E.F. Hutton and kind of building the fund of funds business there.
Well, you've done your homework. You read the case study, I guess, done at Harvard and Stanford. So yes, I took the summer off after graduating from Stony Brook. Graduated in 3.5 years, very anxious to get out into the real world and make some money. I took the summer off. I went into the yellow pages at the time and looked for all of the Wall Street investment firms that there were. I compiled a list of 30 firms. And while I was in Europe, where I had my summer break, I bought my first business suit. It was a wool pinstripe suit that I kind of recall I paid $90 for. And I actually had 30 interviews lined up. And what I would do is if I had a 10 o'clock interview, I would arrive at the office building at 9:30 because my interviews began in late August in New York City, where the temperature and the humidity was incredibly high. And that one suit was a wool pinstripe suit. So I had to cool my heels a little bit in the lobby before going up to my interview. But anyway, I was 0 for 29. Basically told you have no experience, you have no background. Thank you, but no thank you. And then in my 30th interview was with a gentleman from E.F. Hutton and Company. He offered me a job into the training program. And I was so surprised and happy that he said, "You have the job." And he repeated after saying, "You have the job, it's $1,000 a month." I thought he meant that I needed to pay him $1,000 a month to go into the training program. So I immediately said yes, not knowing where I was going to get the $1,000, but I immediately said yes. And that was the story of my initial job interviews and my first job on Wall Street.
And then from then, you developed, if I'm correct, the fund of funds business within E.F. Hutton. And E.F. Hutton became Shearson Lehman Hutton. And then you and Henry Swieca, your partner, went off on your own to, first of all, found Dubin and Swieca Capital Management and then Highbridge. Is that the correct order?
Yes. So I worked at E.F. Hutton and Company. My childhood friend, Henry Swieca, was at Merrill Lynch at the time. We decided to join forces together and form a partnership focused on not transactional business, as many of the retail stockbrokers were doing, but on allocating capital to third-party managers. And the advantage that we had at E.F. Hutton is they had a very interesting program, very progressive program at the time called E.F. Hutton Suggests, where they allowed their brokers to gather money from clients and allocate it to third-party managers. And as opposed to getting paid on a transactional basis, you got paid a management fee. And Henry and I thought this was a much better business model to create value for ourselves than doing transactional business and calling up a prospective client and trying to sell 200 shares of IBM or buy a corporate bond, but rather to gather assets and try and allocate them to independent professional money management firms.
And so, if I'm correct, after that, you kind of wanted to, instead of starting Highbridge, instead of allocating the third parties, you wanted to kind of build up those uncorrelated return streams within your own fund. And that was the idea for Highbridge. But other than that, what was the vision behind Highbridge? What were you looking for when you started it? And there's a really important point I want you to make about legacy and kind of building it for legacy rather than, you don't want the largest hedge fund, you want the one that'll stay around the longest.
Right. Well, before we get to Highbridge, let me just finish the chapter about the fund of funds business that Henry and I shamelessly called Dubin and Swieca. We started that business in 1984. We had many early mover advantages of being very early in the hedge fund evolution. We found some great managers early on in their careers and began to allocate capital using modern portfolio theory to try and find uncorrelated return streams in the form of these third-party managers. And in the late 80s and up to the early 90s, we built actually a very successful fund of funds business. We had at the time over $1 billion of assets under management, which is a lot of money at any time, but back in the early 90s, it was a real lot of money in the alternative asset management world. We had a great business, but we were looking at the managers that we were allocating capital to, and quite frankly, we were a little bit envious that we were getting paid a 1% management fee and a 5% incentive fee above a 10% hurdle, whereas the managers that we were allocating capital to were getting paid a 2% management fee, a 20% performance fee. Some of them are even getting paid a 4% management fee and a 30% incentive fee. And we said, well, isn't this wonderful? We've got a great business, but we'd much rather be principals as opposed to agents. So let's start our own hedge fund business, but let's borrow those same modern portfolio theories that supported our fund of funds business and apply it to internally managed strategies as opposed to externally managed hedge fund managers. So we built Highbridge. We started Highbridge, I should say, in 1992 with $35 million of capital. The first strategy we developed was a U.S. convertible arbitrage strategy, followed by a non-U.S. convertible arbitrage strategy. And we slowly but surely began to build out multiple strategies that had the characteristics of being uncorrelated to one another, thereby reducing the volatility and increasing the return of the overall multi-strategy fund over long periods of time.
And I just want to kind of touch on the first fund of funds business that you and Henry started was called Dubin and Swieca Capital Management. And a very important point for people that don't know much about Highbridge and Glenn, I'd recommend reading the Harvard and Stanford case study about them. But you started Highbridge and you consciously ensured that it wouldn't be named after you guys because you wanted to build it for legacy. You wanted to build it for longevity. So can you talk a little bit about why you wanted to build it for longevity and also the steps you took differently than other hedge funds?
Sure. Well, the first one is somewhat obvious. We didn't name the business after ourselves, unlike our fund of funds business, where we did shamelessly name the business after ourselves. In the case of Highbridge, we named it after a neighborhood in northern Manhattan, Highbridge Capital. So that was the first point. We had looked at predecessors in the hedge fund industry that had gone on and retired, and realized that, once they retired, they didn't really create any franchise value. Michael Steinhardt is a good example of that, and Steinhardt Partners. So once Michael said, I don't want to do this anymore, I want to retire, there was no more franchise value. So we said, well, the first thing that we have to do is, not name the business after ourselves. So we picked Highbridge as an example. The second thing that we did, which was, I think, equally as important, as opposed to being the traders or the investment portfolio managers ourselves, which Henry and I never were, we were the business builders, we were the risk managers, we were the asset allocators. We had to identify strategies and businesses that had more of a process orientation to them than strategies simply find a great portfolio team or portfolio manager or trader that can out-trade other people in trading currencies and dollar yen, or let's find a great stock picker, or let's find a great credit manager. What we were trying to look for are process-oriented businesses where the portfolio manager was part of a team, and the process was an investment process that involved creating investment returns, excess returns. And examples of that were the strategies that we gravitated towards. So the convertible arbitrage business, both domestically and internationally. Again, as I mentioned, convertible arbitrage really is a process business. If you think about it, you're almost acting as a non-bank bank. What you're doing as a creditor to these non-investment grade companies is lending them money in the form of a bond. But you're lending them money at a below market interest rate. And in return for accepting a below market interest rate, they give you a call warrant or a call warrant or option on their underlying company if it goes well. And to protect that loan that you've just provided, the money that you've just lent to that company, you short their stock, which again hedges the downside of that particular corporate credit in a very effective way. So that's what we refer to as a process, almost like a lending business to non-investment grade companies. Similarly, the risk arbitrage business, another business we pursued. What we're trying to do is we're trying to underwrite the probability that a transaction, a stock for stock transaction, is consummated over a period of time. So you buy the company that's being acquired, you sell short the acquiring company, and you deliver the package over a period of time for a defined rate of return. So that, again, is a process-oriented business.
And I think there's a very important point to be made there in terms of management. Not only did you and Henry step back, or originally weren't traders, because if you left, then the whole thing wouldn't go kaput. You guys were managers from the start. You guys managed the businesses, but not only did were you guys not traders, but you ensured that each vertical within the business didn't have one superstar trader, one superstar dude that kind of managed all of it, got all of its returns, got everything. You built processes out instead, which I think is very important because the business wasn't relying on one or a handful of people. It was
Exactly. It truly was a business. Yeah. And that was the criticism in the early part of the hedge fund industry, is that, these are not real asset management businesses. These are just individual partnerships with star portfolio managers, star traders that are generating exceptional returns for their LPs. We saw it much more as a business. And fortunately, so, we started the business in 1992, and now we're kind of in the 2005 period. And in 2005, we were in discussions with JPMorgan about them buying a strategic interest in our business. From their perspective, they appreciated the fact that Henry and I were the business builders, asset allocators, and risk managers, and to your point, not the talent generating the excess return, generating the alpha. So it really did have franchise value above and beyond just the two of us. And what we saw in JPMorgan, it was actually bought by JPMorgan Asset Management business, is a very large, very successful institutional asset management business that we could partner with and, quite frankly, learn best practices from, in addition to continuing to grow and develop our business. And so it was a fantastic partnership. on both levels. We started the business, as I said, in '92. Started the partnership rather with JPMorgan in 2005. At that time, we were a $7 billion multi-strategy hedge fund. So a very successful, but single product multi-strategy hedge fund. When I left the beginning of 2013, it was a $35 billion alternative asset management business. But I think most importantly, by virtue of the strategic advantages that we were given by partnering with a large money center institution, we built out a physical commodity business, a merchant energy business. We built out a very robust and very diversified quant equity business. We built out a very successful private credit business called HPS, Highbridge Principal Strategies. So we did a lot of businesses and strategies above and beyond what a traditional hedge fund could have done on their own.
And I want to touch on each of those a little bit later. But then after you stepped down from, so JP Morgan fully finished their acquisition of Highbridge in 2009. And then after that, when you stepped down as CEO, you went on to found your family office, Dubin Co. And what was kind of going into your family office? What was the vision? What were the companies you were looking to invest in with your family office?
Well, when I finished I actually stayed on a little longer past 2009. I stayed on, they asked me to stay a little longer because some of the businesses were still in development. And so I ended up staying till the end of 2012, beginning of 2013. And I knew that when I left and would start my family office, that I didn't want to be passive in what I was doing in my family office. I didn't want to allocate money to third-party managers. That, frankly, I'd find that pretty boring. But I wanted to continue to benefit from my 30 plus years of being in the alternative business, be informed by all the experiences I've had in building out those businesses, and try and identify, cherry pick, if you will, those businesses that I thought I could recreate in a family office environment and have an edge. So the first business that we started was actually a business that was started at Highbridge, a partnership between the Louis Dreyfus family and Highbridge, our fund, where we formed a joint venture and created a merchant energy business called Louis Dreyfus Highbridge Energy. When I was ready to leave in 2012, end of 2012, beginning of 2013, I knew that the Louis Dreyfus family was looking for liquidity for some of their family members. I also knew that Highbridge had an experience of owning this asset for a period of time and was also interested in liquidity. So I went to senior management at JP Morgan and said, it's time for me to leave. I would like to leave, but I'd like to buy this asset. And they correctly said to me that I really had to put together an investment group together and have an arm's length transaction, which we did. And we ended up buying Louis Dreyfus family's interest with an investor group. I ended up buying Louis Dreyfus' interest in the business and Highbridge's interest in the business. And the new co is called Castleton Commodities International. And Dubin Co was the lead shareholder. I started out as being the executive chair and having 2 board seats. And that was the first investment that we started out of the family office that's been highly successful.
And you've invested in a lot of other companies. Can you tell us a little bit about the other companies you invested in? I remember Environment as being one. There's a couple of biotech hedge funds that you seeded. So tell us a little bit about that.
Sure. I'll walk you through quickly in chronological order. It's been 11 years. So the first business was Castleton. The second business that we started was a quant equity business. I mentioned that quantitative equity trading within Highbridge was a highly successful strategy for us. We had a great team and ran a lot of capital very successfully. So we started, I seeded within the family office, a business called Engineers Gate. And Engineers Gate was meant to be a multi-manager platform focused on quantitative equity trading. Little did I know that the business of quantitative equity trading is a very technical, very complex business. It requires very sophisticated technology platform, risk management systems, historical data, and the depth of the J curve, so to speak, the amount of time that it takes to build out the business and really become profitable, it takes a long time. But anyway, we started to build out that business. We had a number of portfolio teams that we had built, or excuse me, recruited. We had built a very sophisticated operating and technology platform. And then in 2014, 2020, made the decision to spin that business out and attract outside capital, third-party capital. And my partner at the time, Greg Eisner, became the CEO of the business and has been operating that business very successfully as an independent hedge fund.
And looking back on, you've invested in a couple of other businesses too. We've been
involved in GP seeding. We seeded a small middle market biotech fund that is one part public equities, one part early stage private equity. We seeded a small middle market private equity fund in the consumer space. Made a number of investments, venture investments, early stage technology investments, early stage biotech investments. So really, been very active and very busy over the last 11 years, building out a diversified family office across everything from physical commodity trading to private equity investing in small middle market consumer businesses. So we've had a lot of fun.
Yeah. And after you sold Highbridge to JPMorgan, you could have easily just been a passive investor and somewhat retired. But why do you think you wanted to stay on as an active? Do you think it's something about you? Do you think it's something about your nature? Why did you keep wanting to be an active investor?
Well, I think my wife tells me that I have a screw loose, that I've got to slow down and stop working as hard. But the honest answer is I enjoy what I'm doing. I really look forward to going to the office. We've got a bunch of people in the family office that are very talented, very smart. I enjoy the camaraderie. I enjoy the dialogue. I enjoy building things. I enjoy being a mentor to younger investment professionals, which is another important part of what I've done out of the family office. And I find it very stimulating.
And among the people you've mentored that turned out to be successful, and among the investments you've made in your family office in which the companies have turned out successful and they're successful CEOs and such, what do you think are a couple of common themes that you see across the successful CEOs that you've either mentored or invested in, et cetera, or founders?
There's an element of pattern recognition, Amir. I've been doing this for, it's hard for me to even, think about how long I've been doing it, but 44, 45 years. And after a while, you spend time with an individual, you get to know them better, and you have a sense of whether or not this person is somebody that you want to be in business with, and B, whether or not they have the ingredients to be successful in what they're doing. Now, it's not foolproof. I've made many mistakes in my career, but I also have a reasonable track record of identifying talent. And so, the identification of talent is one part. The mentoring and the helping build a business and a strategy and having a longer term strategic plan is another part. So I try and spend time with young investment professionals, imparting whatever knowledge I have and have gained over my 40+ year career being in the alternative asset management world.
And there are you've been across a lot of investment businesses in your career. There are many great traders, amazing traders, but there's very few great traders, great investors, and great leaders. What do you think makes a great leader a great leader? What are the traits?
Well, a great leader is, it's not just in the investment world. It's in the world at large. But a great leader is somebody that commands respect, somebody that's admired, and somebody that has a vision that people want to engage with and follow. So I think, leadership has different forms, but, leadership is most important during difficult times. Leadership is less important during good times. And so I think, the leadership qualities that I've seen demonstrated are most apparent during bear market periods, market dislocations, where people are generally feeling very down and uncertain about their futures. That's when leaders in the investment world tend to stand up and shine.
And circling back to your family office, across all the businesses you've invested in, seeded, et cetera, what are a couple common themes you've seen looking back?
Yeah, I tried to use my 30 plus year career in the alternative world as an information basis to inform me about businesses that I thought were attractive and that had where I could have a competitive edge. I think now, as I look back and kind of examine the businesses that I've started or helped seed over the last 11 years, the common theme is they tend to be small middle market businesses or businesses that large asset management organizations can no longer participate in, either because of liquidity reasons or because the market opportunities simply aren't there for a large asset management, a large asset manager. So a lot of the opportunities I've identified have been in a small middle market space, and that goes to the commodity business, the energy business, where we're focused on trading and identifying asset opportunities that are below the radar screen for the big majors and some of the big trading firms. It goes for Engineers Gate, that's focused on a lot of strategies that cannot be scaled, that are capacity constrained. It goes to the small middle market biotech business. It goes to the small middle market private equity business. So a lot of them, the common theme seems to be, let's try and identify these markets or strategies or sectors that still have a lot of alpha, but are constrained in terms of how much capital you can invest in that particular area. And typically what happens is that, a lot of the great managers start their careers or start their businesses in the small middle market space. And then as more and more investors want to give them money and their asset base grows, they have to move up market. And once they move up market, they leave this void in the small middle market. And so again, if there's a common theme within my family office investment activities, I'm focusing more on the small middle market alpha than I would be if I was running a, many billions of dollars in an asset management business.
And I think although some people that are smaller in scale to larger know that there's more alpha in those smaller businesses, there's kind of, first of all, people want to make more money, obviously, but there's also kind of ego in it. They want to get bigger, they want to get, and it's kind of going against human nature to invest in those smaller businesses. And you've already built up quite a reputation. So I wouldn't assume there's much ego at play for you to go into those smaller businesses, to invest in them, and to seed them. But I want to talk a little bit about your risk management approach. So you mentioned that you and your partner, Henry Swieca, very successful partnership, and you balance each other out well. You said you were more of a risk taker and Henry Swieca was less of a risk taker. How has your risk approach changed throughout Highbridge and then going into Dubin Co?
Well, I don't know that I necessarily said that I'm more of a risk taker and Henry was less of a risk taker. I'm saying there was a great partnership, a great balance, and partnerships that work, there is that balance. And usually what happens is you have one person on a risk spectrum and the other person on the other side of the risk spectrum, and you end up meeting in the middle. And I think in my partnership with Henry during Highbridge, that was the case, and the returns reflected that. We had exceptionally good returns with a very attractive Sharpe ratio. I will say the difference between running your family office and being a fiduciary and running a hedge fund, you look at risk differently. Quite frankly, you're much more risk adverse and risk sensitive when you run third-party capital. You're very concerned about drawdowns. You're very concerned about consistency. You're very concerned about delivering bad news to your investors. At least we were. And you tend to be more conservative, and you tend to be much more risk adverse. I won't say that I've thrown caution to the wind in my family office activities, but I will say that, after 40 plus years of market experiences, I understand the volatility in the world, that there is volatility in the world. I understand the market cycles. And because I'm not managing somebody else's capital, I'm managing my family's capital, the emotional toll or the emotional volatility that I have when the markets are volatile is much less. And quite frankly, that's greatly appreciated, because it's very stressful to run third-party capital when you go through a very volatile market environment. For instance, the market environment we're in right now, the beginning part of 2025, is not for the faint of heart. I sleep well at night. I don't know that I'd be sleeping as well if I was running, a very large hedge fund with a lot of third-party capital. But it's definitely a different mentality and a different perception of risk aversion when you're running your own money versus running third-party capital.
And I think it helps a lot that you've already run a lot of third-party capital, so you've kind of built up somewhat of a tolerance to it and a confidence in your own opinion. But I want to move on a little bit to philanthropy. So philanthropy has played a very important role in your life. You were a founding member of the Robin Hood Foundation in New York. Can you tell us why philanthropy has played an important role in a couple of ventures you're involved in?
Well, as I mentioned, I grew up in a very modest background, upbringing, Washington Heights neighborhood of northern Manhattan. And I had some success early part of my career. And I was fortunate to have met Paul Jones, a famous macro trader, very early on in his career. And we allocated some money to Paul and Tudor Investment Corporation in the mid 80s and in the late 80s. And Paul famously predicted the stock market crash of 1987 and made a lot of money for his investors. And the prediction was based on an analog that he saw in the markets, that what was going on in the markets in 1986 and 1987 was eerily similar to the charts that he looked at of the 1928-1929 period. And he was quite convinced that same market forces and emotions that caused the stock market crash in 1929 were bubbling up and would potentially cause a crash to the stock market in 1987. And needless to say, he was right. He was positioned effectively, made a lot of money in 1987, and thought that parallel was going to continue, and felt that we were going to go into the next Great Depression. Fortunately, he was only right about the crash and not right about the depression, but that created a catalyst for him to say, I want to give back and I want to start an organization to fight poverty, because I believe poverty will be endemic to our society. And so he invited me to participate in the Robin Hood Foundation in early 1988, soon after the stock market crash, as a co-founder. And the goal was, let's try and fight poverty because it's going to be rampant. And let's try and use business principles that we've learned in our business lives and apply that to philanthropic giving. So that was the beginning of Robin Hood. I was introduced by Paul Jones. And you're correct in saying philanthropy has had a very important part of my life, my wife's life, my children's life. And I owe a deep debt of gratitude to Paul for introducing me to Robin Hood and to the pleasures of giving back.
And correct me if I'm wrong, but Paul was part of the investment group in Commodities Corporation with you.
Paul and I are extremely close friends, and our families are very close. I am proud to say that I introduced Paul to his wife, Sonia. They've been married for 35, 38 years, for a very, very long time. Paul and Sonia's children are very close to my children. And paying it forward is that one of Paul's daughters introduced my daughter to her husband. So we have a very close family relationship with Paul Jones and Sonia Jones.
Yeah. And I want to ask you a question about any trends or tailwinds you see in the next decade or 5 years to a decade time horizon, because you've been quite successful at identifying trends and tailwinds and taking advantage of those throughout your career.
Well, the thing that we're excited about right now that we've begun to invest in are roll-ups of service businesses. I have to, full disclosure, my son started a roll-up, and we gave him some capital, and he's done an amazing job in the home services vertical, rolling up garage door service and maintenance companies. But it goes beyond just home services. It is in a lot of business services, accounting, insurance brokerage. It's in a lot of industrial service businesses, plumbing, HVAC, landscaping, and really what these managers are doing, or these founders are doing, is taking these highly fragmented businesses, consolidating them, and bringing best practices to the business. And best practices could be digital advertising. Best practices could be savings and procurement procurement savings. Best practices could be training. Best practices could be cross-selling. I mean, there's so many things that you learn that can be applied to these successful mom and pop organizations to make them more efficient and make them more profitable. So it's a very interesting sector. And now what's happening is that the sector is kind of moving out of just the industrial services sector. It's now starting to move into business services, as I mentioned. And some managers are starting to look at it and apply artificial intelligence applications to help make the businesses more efficient as well. So it's an interesting trend. It's still in the relatively early days. If you get it right, there's significant upside. It has venture-like upside with, frankly, higher probability of success because you're buying existing businesses that at reasonable multiples, very reasonable multiples. And the upside comes from the multiple arbitrage. If you're fortunate enough to consolidate and create critical mass, to sell it or bring it public at a much higher valuation.
And I want to give a shout out to a competitor, but your son Jordan did a very good podcast with Acquired Minds. So I think it's very interesting for anyone my age who wants to listen to it. And I also, you've also been somewhat of a mentor, and you've been an investor in Garnett Station Partners, which kind of follow that kind of theme. They're a franchising private equity firm, and I'd highly recommend anyone listen to Matt and Alex's podcast with Invest Like the Best, or read the Wall Street Journal article. I think there's a lot to be taken away from it. So there's a common theme there among young business graduates or students that, and it's looking like the next big thing. And one final question we ask to every single one of our guests: if you were to give one piece of advice to your 15-year-old self, what would it be?
I'd probably tell my 15-year-old self, slow down. And I would give you this advice as well, Amir, because you're obviously very ambitious and very commercial and very keen on being successful in life. But your career is going to, be across decades and decades and decades. And what you have to do is you have to be very thoughtful and very careful, recognizing that, again, you have long duration and you'll have a long career. You're going to learn from your mistakes, and you want to learn from your mistakes, and you're going to benefit from your experience. Experience is going to be a compounding asset. So just slow down, be thoughtful, be mindful, and recognize that your career is going to be many, many decades.
Thank you, Glenn. I very much appreciate it. This has been a long time coming, and I'm glad we got to make this happen. Thank you for coming on.
Likewise. Thank you very much.